We saw that a bit in the tech bubble. I mean, there's lots of secular there. Obviously, the new paradigm was for real, but some of that got overhyped. We talk about commodities never going to go away because China and India are going to grow forever. There's been, there's some commodity investors in this room, I'm sure, and there has been, you can make a lot of money, and most of you probably have, but don't ever forget that the commodities are highly cyclical. The China story is good for a run here and there, but it's highly cyclical. So if you think about what creates a cycle, well, demand goes up a little bit, there's not enough supply, so prices go up. What happens? Well, prices creates more supply because people invest in the business. Widgets are got fat margins, we better produce more widgets. So as that supply comes on, perhaps maybe demand slows down a little bit. Suddenly you've got your awash with inventory, prices are coming back down. Eventually people lose money, people stop investing, you create the cycle again. It's pretty simple, but it happens. So I bring this up, it's pretty basic, but don't keep it in the back, keep it in your toolkit at all times. I'm not saying there aren't really powerful secular trends. We talked about media here tonight. Clearly what's happening to some of these media companies is a profound secular trend. But as investors and value investors, you can take advantage of cycles, but you got to remember there are cycles. This maybe isn't aimed at this group, but I put this up with every kind of chance I get to talk about this because there's so much attention in the markets to how do I de-risk my portfolio. I can't tell you how many clients come into our office and they're looking for something different. And sometimes it's on how we deliver our product and how we converse with our client and our fees, and that's all great. They're there for the right reasons. But sometimes they're coming here because they want 10%, no risk. And investing, what you are all is risk managers. You're risk managers. And there's 4 kinds of risk, as in my sort of, maybe it's a little academic, but way of thinking. There's interest rate risk. There's credit risk, so owning corporate bonds or something that's not a secure piece of fixed income paper. There's liquidity risk or liquidity premium. In other words, buying a mortgage from your brother's building instead of a very highly tradable bond. You'd expect your brother to give you a much fatter interest rate, and that's the liquidity risk or premium. And then finally, ownership risk or equity risk, the one we all think about. But that's our playing field. You just want to make sure you know what they are and use them correctly. But risk and volatility, which we could get into in the Q&A, is your friend. And this is a pretty young crowd. When markets go down, you shouldn't be pissed off. You should be jumping out of your skin, because you're going to get to buy more shares of whatever, J&J or Cisco or whatever it is, because you don't need the liquidity. You're going to sell it down the road. So I always remind audiences I'm in front of, let's use risk to our advantage. Now, I was asking if some of you are hardcore value investors, and I think there's a few in the crowd. But you know what? Whether you're hardcore value or your growth or whatever, it all comes down to price. And last, I guess it's almost a year and a half ago, fall of 08, early 09, been ugly. Certainly our clients and I got hit a lot. But we, in October, we were probably a little early, but we started to talk about buying. And we got out on the road a few times and we talked to our clients, and they all said to me, Tom, look at this environment, look at the debt, look at all of this the consumer being overburdened in the U.S., all the rest. I said, isn't it awful? I said, yeah, it's ugly. Who knows what's going to happen out there? But why were we so, it was basically as proactive as we'll ever get, because we're not big market timers. It was price. Very good long-term assets, ones we knew would be around for a long time, were ridiculously low priced. And so that rally off the bottom, that I don't know what it ended up being in total, at least 2/3 of that was just revaluation, coming back to more reasonable valuations. And now we can argue later about whether we're fair value, overvalued, whatever. But don't. And I think if you are value investors, Think about Europe today. Why would our global fund ever own anything in Europe? Well, it's price. There's lots of good businesses in Europe, and I think we have to remember that. We're all, as individual stock buyers, if you weren't looking for inefficiencies, then you'd own ETFs. As individual stock buyers, we're looking for inefficiencies in the market. And inefficiencies, in other words, if you're going to be what we call a long-only investor, like we're going to buy, then it's undervalued securities. Now, if you've got the scope and you want to take the challenge of being a shorting things, which is another whole mentality, then overpriced, you can take advantage of inefficiencies in overpricing. But the one enduring inefficiency that I've seen over 27 years is time frame. And maybe it's too basic, but as investors, when we find a security we like, or in our case, maybe it's a fund we like or a manager we like, you have to be prepared to have a longer time frame than the masses, than the media, than the commentators, because that's what's creating the opportunity. But it's always there, but it's a test. It's hard on the gut. It's hard on where your head's at and all that stuff. Final thing I'd say is I guess this is speaking from the profession, but for all of us, this is a perverse profession. I mean, you think about, I learned this from bond guys at first. When I first went to Phillips Hager and North, I knew nothing about bonds. And I had, $100 million pension clients that had bonds in their portfolio. So I spent a few weeks just hanging out on the bond desk and learning. And what I learned is that the bondies are the most perverse people of anybody in the industry. When they, if you think about it, when economic numbers are coming out, they're cheering for bad numbers. Because bad numbers in the economy are good numbers for bonds and such on. So I finally said to them, can't you ever cheer for the home team? Come on, some good earnings or something good. But you know what? The whole industry is like that. All of us as investors, make sure you've got a little bit of perverseness in there somewhere. In other words, if everybody hates something, that's when you maybe pull out your pad and get online and figure out if there's something there of interest. There might not be. It may be a very legitimate reason for hating something. But and likewise, I learned this what we call market sentiment. And there's a whole field of study around market sentiment. And I learned it from Art Phillips, actually, the founder of Phillips Hager and North, a brilliant investor. And Art wasn't what drove his portfolio, but he always tracked, I think it was 4 different measures of sentiment. It was newsletter writers, it was traders, it was portfolio managers, and then it was individual investors. And there's I think way more surveys now, but there's surveys you can get. I think you can probably just find them online, that says how bullish or bearish each of these segments were. And if I think 3 or 4 of them out of 4 lined up, that was a buy or a sell signal. And that didn't mean that he just went crazy and didn't do valuation work and all the rest, but it told him that he had either very fertile ground and time to dig in and make sure he's on top of his game, or not very fertile ground and maybe time to put a little hay in the loft and peel back. So I raised this as maybe a sort of an intro into just some Q&A and the interview, in the sense that I think go into it with that in mind. And people, and I use Europe as an example. I don't have any axe to grind on Europe. We're not really buying in Europe right now, but Europe is an example where you probably, if you were doing international investing, that's probably where you should start digging in, because Europe markets have been hit harder than elsewhere. And so I think that's something to keep in mind. So I'll finish with my favorite quote from Mark Twain, really just to say that you all got to have a view. If you own individual stocks, you got to have a view on things, but don't get married to them. Don't be prepared for them to be wrong. The best in the business, the Frank Mershes, the Peter Lynches, the Warren Buffetts, you've probably seen the stat, are wrong 40% of the time. Or they're probably, in reality, they're probably wrong 20. They're, kind of neutral 20, and then they're right 60. But believe me, you're going to make lots of mistakes if you want to use that risk to your advantage. So that's all very broad and very general, but really just to set up however you want to do this, and let's talk investing.
Sure.